Hello, I'm Harry Tchingulairan, Group Head of Research at Onyx, and I'll be joined today by Jorge Montepeque at the far left, and with Remona and Melis from our sales desk. And we're going to be talking about crude oil markets, focusing in particular on the Brent Dubai spread. And we're going to go a little further than just looking at the fundamentals surrounding the contract. We're going to be looking at Onyx's proprietary data sets that help to enhance market analysis. So Onyx has developed, as you know, a proprietary data set that essentially leverages our trading and market making activities in order to come up with a set of data that allows to identify positioning by different market participants. So the COT market positioning that Onyx has developed is free and available on our website, aggregated along the way of the CFTC nomenclature. But we also have, by subscription, a set of data that goes into far more granularity when it comes to the participants by subscription. So with that, I'd like to first start off by talking about the physical crude market and diving a little bit into the fundamentals of Brent Dubai. For that, Jorge, could you let us know a little bit what the price action has been on crude markets in general, and of course focusing a little bit on Brent Dubai. There's been a lot of things happening in Dubai, a lot of uncertainty around Chinese oil demand in particular. It's how much the refiners are going to process, the level of imports, but also question marks around what OPEC might do in the future. But if you could take us a little bit through what has been happening, and then we could delve into the spreads.
We have a news hub, a research hub, and then parts of the company also trade, but we are separated from them. In what we observe here in this side, we are very front end. So we're looking at the market real time, how it is moving. And it is always an amalgamation of long term fundamentals, macro analysis, and then micro events and the interpretation of the traders of those micro events alongside of all those long-term fundamentals. As it should be obvious to our readers, we have had a point of view that the macros are rather negative and they tend to be reinforced every passing week, particularly in Asia. China is not doing very well. Their consumption of consumables really seems to be going down. Their consumption of energy, we cannot figure out why some people say it's going up. We actually don't see it.
Data team seems to point the other way, actually.
Yes. So it's a negative picture. But within that negative picture, we may have massive bull rallies. And these bull rallies are triggered by some micro event or a trading event. And I think it would be fair to separate them between the two. In the past, all in August, since the end of July, when we had the Israeli Hamas attack against Hamas in Tehran, the market has been essentially on a bull run because they were expecting, on the aggregate, for Iran to retaliate against Israel. And that provided the emphasis for the market to go up. So we would say that's a micro event because it doesn't change the long-term picture. In effect, if you start messing about with the routing of ships in the Middle East, you would say the Asian economies would be hobbled further because their normal chain lines are being disturbed. But that creates a bullish short-term scenario. And that bullish short-term scenario, one way or another, falls on Dubai, which rises alongside Brent. And so if we look at the price charts, we have seen the two crudes rising. But very interestingly, Brent has risen far harder than Dubai. So one of my takeaways internally here and for the market at large is that you cannot look at things individually. You have to look at things in the aggregate. And in the Dubai market, you can look at Dubai, but you must look at Brent because it's a relationship.
Certainly, just to add on to that, and for our listeners, is the current front month Brent Dubai swap is trading at a little around 60 cents, I think, per barrel. And what Jorge described is essentially a situation whereby we have a contango in the Brent Dubai swap curve. So interestingly enough, we're looking at a situation where, in trading terms, you look at Q1, the premium that Brent has over Dubai is widening, at least on the curve.
So you have a front line curve where it is pricing. So you have Brent, which is October, trading this month, and you have Dubai, which is October, trading this month. And that creates the pricing of all the swaps that you took for the month of August. And those spreads are separating between the two. Then you have spreads between Brent and Dubai, or intermonth between Brent or Dubai, or boxes that are for September, October, November, December, and so on. And then that is a forward interpretation, a reflection of the forward interpretation of what the market thinks supply and demand will be, taking into account what will be the potential micro or trading events in that area. The product that Onyx is putting forward gives you a glimpse into the positions, or rather pre-positions, that the market is taking into those areas. And then you start looking in granularity whether the, let's say, the trade houses or the hedge funds, capital markets, or physicals are going long or short one versus the other.
Absolutely. That's sort of the hallmark of the Onyx Community of Traders data that we'll be going through with Melis and Remona. And that's definitely one part where we will delve in even into more detail in the show. But you're absolutely correct in highlighting this important addition to the overall, I guess, toolkit that we have between micro events, macro events, and what we're going to see today in this show when it comes to the actual additional tools that you could get from Onyx in order to better understand the dynamics that are driving something like a Brent Dubai spread. I just wanted to ask Remona, do you have further thoughts on the Brent Dubai spread in terms of why we have chosen today to illustrate our commitment of trader data here at Onyx with this particular spread? What was the driver of your choice? Why did you want to focus in particular on Brent Dubai?
Thank you, Harry. The reason why we actually chose Brent Dubai is simply because it's a very important differential in the swap contract, particularly for the Asian to European arbitrage benchmark. And sweet barrels, they trade at a premium compared to sour grades, since they have higher and better quality. Like Jorge said, Chinese demand and the whole weak Asian outlook has actually affected prices both into the spread differential and Dubai crude markets. And also recently the Saudi OSPs, they have been quite an interesting one to look especially for this curve. And most interestingly, recently we actually had the Canadian pipeline as well, the Trans Mountain pipeline that extended further, and actually many Chinese players, especially refineries, actually from Japan it was in the news, and also China itself and South Korea have been actually importing Canadian grades from Canada to the Asian side. So we thought to delve better into the Brent Dubai differential.
No, absolutely. I mean, in terms of one of the key differentials dictating arbitrage barrels from west of Suez to east of Suez, when it comes to looking at the dynamics of light versus medium or sweets versus sour, this is certainly the one spread to watch. And as you highlighted, beyond the normal, or I would say the regular drivers of this market, we've had now a supply innovation in the sense that thanks to TMX, we're now getting another source of medium or heavier sour crude entering this market. And that could complicate the dynamic of what used to be a Brent versus Dubai, which is now a Brent versus Dubai plus. In order to look a little bit closer into this market, as I was saying earlier in the show, we want to try to, obviously we can't go extensively into detail, but at least give you an overview that's sufficiently precise of the COTs, or what we call the COT of Onyx, and show you how you may be able to extract more information in addition to all the things that Jorge has told us in terms of drivers of this particular spread, and how crude markets have been evolving against a fundamental context, against trading events, against geopolitical risk, and so on. So I think maybe the best place to start, Melis, is the starting point for almost everything we do with the commitment of traders data, and that is looking at open interest.
Exactly, Harry. Well, utilizing Onyx dashboard, we can actually assess what the market risk is. And for that, let me actually show it to you. Right now, by clicking the tenor for the last month, I can actually see the open interest here. So what
are we looking at exactly at this chart then?
So before going into that, what's unique about this data set, this is the only external data set that we are getting into Onyx Commitment of Traders dashboard. And this open interest, this is actually accumulation of open interest coming from ICE, CME, and SGX. Here you will be seeing 3 lines. This brown line here is the 5-year maximum. What I mean is that the maximum open interest that a September contract has ever reached in the past 5 years. Whereas in this navy line, this is the average a September contract over the past 5 years. But the main thing, the most important one, I am assuming for now, is the current open interest that we are seeing here. What is interesting about this is that even though there is about 1.5 months to expiration, we can see that the current open interest is well above the 5-year maximum, which kind of indicates an overextension of the market risk, leaving actually a very limited room for market to add extra risk into their positions.
So we're actually prematurely at the end of our risk capacity cycle. So it's very interesting when we actually look at how a particular tenor is going to behave for any price, for that matter, is to actually be looking at how much people are already positioned on that particular contract. So in this case, we're looking at the September Brent Dubai, and it's amazing that we have managed to exceed the maximum open interest for this contract, a September contract, so early in the game. Question is, an event risk, a trading event like Jorge was mentioning, can lead to unwinds, profit taking, stop outs. This is a very vulnerable time, I would say, for the contract.
Let me interject a little bit here. And looking at the graph, to me, becomes very clear that even though it's not horizontal in its behavior, from this period to that period, it's really is trending and unable to break upwards from that range. So the market is kind of done. It's
done for now.
As much as it kind of wants right now, unless there is another exogenous events that allocates further capital into this sector.
Yeah, and this is, I guess, a starting point. This is sort of the building block when it comes to using our commitment of traders data in analyzing the behavior or potential behavior of any contract on any tenor. Is there capacity for risk or not? And it seems that, like you're saying, they reached their maximum or satisfied their risk appetite early on, and we're now obviously trending horizontally in terms of market participation. So from this, from open interest, I guess, the question is now trying to look at, in terms of what the next step is in analyzing using our data. So I would suppose at this juncture, the next step is to start looking at what prices actually did, right? And for this, we have our Flux platform, right? And so I'll let you take us through basically what we could see on Flux, and then what we're going to be looking at when it comes to our dashboard and prices.
If you don't mind, an additional further interjection, I would say, is that the open interest rose, trended up through the end of July, and then it peaked and has stayed there for the last 2 weeks. So it would almost suggest that it's time for a little tumble, one would say. One cannot say with certainty, but it's kind of pricing spread in August in the front end is coming in around close to $1.50, which is a very different value from the September. So if one compares one value with the other, the September spread is too narrow. But based on this, it gives you some pause that maybe could head the other way. But in all these things, you should be empowered to have as much data as possible. Rather than just one data set of the physical, you should also be looking at the technicals and then recombine the entire thing to make, hopefully, a good decision.
Well, really, that's our journey through our commitment of traders dashboard. So building blocks, open interest, really gauging if the market is vulnerable to a correction, as our friend Jorge is suggesting. But before we get to those kind of conclusions, there's a couple more things we need to look at our dashboard that will help us build our view. So what has the September Brent Dubai contract been doing? And more importantly, what we're going to be looking at and you're going to be taking through is entry level. And you could elaborate a lot more about that and how important it is to be looking at these, because they really do shape our thinking as to what people may do next, right?
Let's actually take a look, Harry, at this chart, which is taken from Onyx's Flux platform. Here, on the top right side of the screen, we have the Brent Dubai differential price starting from the 15th of July, and the orange line represents the Dubai swap September 24 contract. Now, let's actually take a further pause and looking at the general evolution of the Brent Dubai pricing, we can actually notice a bit of strength here in prices starting from the beginning of August and then prices falling down. And again, a repetition of these prices, which can lead us to suggest that this has gone in line with the strength and that we have noticed actually in the Dubai market, in the Dubai contract, and then the weakness in this market as well. However, like you rightly mentioned, is important that we look at the prices in relation to the entry prices, in relation to the longs and the short prices.
I think what you said there is extremely important in the sense that we could look at a price like, or a spread like Brent Dubai. We could look into the reasons why the spread went up or down, and there have been times where this was driven by strength in the spreads of Brent. Sometimes the differential was even driven by weakness in Dubai and then weakness in spreads in Dubai. But at the end of the day, when it comes to positioning and the flow and how that flow could change, at the end of the day, the people who are responsible, or market participants who are responsible for the flow, have to make a determination as to whether they take profits, whether they are stopped out on their position if the market is going against them, whether they could warehouse the risk a little further. And so looking at the price independently from these entry levels doesn't allow you to draw conclusions on what may be. So please show us a little bit about how the representation of these entry-level prices appears in our dashboard.
As you can see from the widget on our COT dashboard on the average entry prices, this is in the last 7 days, but you can also access entry prices in the last 90 days or more legacy one in the last 1 year. Let's actually focus on the short entry prices. In this graph, you can see three main lines. The light blue line represents the price and the price movements. The brown line represents the short entry prices, and the navy line represents the long entry prices. Now, looking at the evolution of price relative to entry prices and precisely relative to the short entry prices, we can see that shorts have been in the money until beginning of August. Then we have seen a change in positioning, and especially from a few days in the beginning of August, shorts have been out of the money. And looking at actually the price, this is quite wide in relative to where the entry prices have been. Now, this seems to be in repetition for until, as we can see here, middle of August. And from the 13th of August, shorts again start being in the money. So, yeah.
Well, I think from a pricing point of view and also from a behavioral point of view, this sort of in relation with open interest opens a window a little bit into trying to think about what could happen. Because the more we deviate from an entry price, the more likelihood, of course, that someone will either stop out, take profits, or potentially, if the momentum is there, continue to add. But as we've seen earlier, our appetite for risk seems to have been maxed out, with the open interest having reached a peak early on, and it hasn't really moved in any particular direction since then. So I think the next step in terms of the dashboard, at least for this overview, is really drilling down and seeing actually who is long and who is short, because that has implications in terms of when you look at in this particular chart, people who have entered at a short level are now currently are in the money in terms of their trade. The nature of these participants could give a good indication in terms of what they may be thinking around the market.
Yes, exactly. So just looking into the participants of the market here, let's make it slightly bigger. We can see that the main holders of the bulk of the open interest is actually producers in the last month, which is actually their natural hedging, like buying the Brent Dubai spread. But the most interesting part is that we can see that in total, this shows that the what market has traded with Onyx. And we can see that since the beginning of August, that we start to see more selling flows. Market has started selling to Onyx. And if you look into it closer, we can see that this selling flow has actually started coming from mainly majors and trade houses. Considering this is not actually their natural hedging flow, considering these are actually physical players, I will say that moving forward, these are the main market players that we need to keep an eye on related with the price action.
So what is interesting is to actually know, to try to better understand why a physical house, a major, is short the spread. Because as I was saying earlier, if they are long the spread, then they're locking in an arbitrage and they're trying to bring oil from west to east. So there's a view from these market participants that the spread between Brent and Dubai is going to narrow. And one could wonder from the viewpoint of a trading house or a major why they think that. So in the context of what we're saying earlier, are these players looking to deliver oil to Asia? And in particular, are they taking a view that perhaps, at least in the short term, after the relatively poor import figures we got from for crude oil in China in July, the weak processing rates, that they are somehow positioning for the return of Chinese buyers?
So to sum it up, if there's an expectation that the spread is going to narrow, visually means this, right? And that can be a combination of Brent coming down, Dubai going up, or a mix of the two. For Dubai to come up, it would mean that the demand in Asia is increasing, and that's why Dubai is being bought. Or there is a surplus in Brent, that is being sold and the price come down. We discussed initially that if the markets are reflecting macros, then what we are seeing is that there shouldn't be a surge in demand in Dubai because the macros in China and in the region are very negative. There's a little bit of a micro event, which is a new refinery starting up in September in the Shandong province, Yulong to be specific. And that is going to suck in maybe 200,000 barrels a day at the start. But they already got the allocations, a little bit of an allocation from Saudi Arabia, and they have bought some Russian crude, surprise, surprise. And therefore, on an incremental basis, I don't see them influencing the rise in Dubai. So if the spread is narrowing, I would look more at Brent, that Brent is coming down. Now, technically, Brent has been very high this month relative to anything else. Whether we want to use a word such as squeeze or any other emotive indication, the fact really is that Brent has been overpriced in relation to anything else. And therefore, the likelihood, if one is correct that it's overpriced, is that it will correct down faster than any correction elsewhere. So it is reasonable to expect that the spread would come down as the fluff goes out of Brent. So I would kind of see those things. And I was indicating earlier that the current spread pricing between Brent and Dubai is, for the lack of a super specific term, call it $1.50. And that already is at 60 cents going forward. So meaning Brent is going to take a big correction down that is already in progress and could continue. So Brent is the thing to look at rather than Dubai, but we need to look at everything on the aggregate.
No, I agree. I mean, it certainly allows us to explore different avenues and pathways for the evolution of prices when we start looking a little bit closer at what lies underneath the surface. So one could look at prices, one could look at the relative strength of one or the other of the crudes as being the driver of the spread. But when we start looking at the positioning and putting in the context of a risk capacity, where are we in terms of the trade cycle when it comes to wanting to adopt risk? In this particular instance, it seems that the risk is maxed out based on the open interest, right? Interesting enough, sellers of the spread, and therefore looking at for it to narrow, we would typically tend to look at relative strength in Dubai versus Brent. Now, you mentioned there's a possibility of it being the other way around, where an element or a layer of fluff comes off of Brent and that causes a narrowing. But if we were to think it in the fundamental context and put it in the this context, in the broader context of when do refinery runs globally rise and fall, and when do they rise and fall, in particular in Asia, then we're looking at a situation where there may be, given the participants and the direction they are, a view that the demand is going to be there. Now, I personally, and I think we share this opinion, that we don't think that the demand or the crude demand out of Asia is going to be turning out as strong as some other people expect it to be. But there is this underlying reality whereby people who have physical oil and who could move physical oil around are positioned in a way that would tend to go towards, at least in the very short term, some uptick in demand, which wouldn't be necessarily completely unsurprising in the context of an exit from refinery maintenance periods. The other thing, and of course, so we invite you to play with the dashboard and look, as I was saying earlier, we have a contango in terms of the Brent Dubai swap curve. And that's open to many interpretations, and we can start looking at who's positioned how to try to see whether the positioning fits our interpretation or contradicts it. But I think for today, hopefully you've seen an overview of how some of the data available on the dashboard, and there's more, allows you to look at the market in a different fashion and be able to draw from it other conclusions than just your S&D or reporting, but try to tie all of that together within I guess a neat bow to draw different conclusions. So with that, I'll leave our panelists to say any concluding remarks in terms of this presentation. Is there anything else we could say, Melis, Remona, on the COT dashboard? Are we looking at adding more things?
Yes, so the dashboard, you can access it on Onyx Hub for everyone who is subscribed to our data services. And apart from the analytics presented today, the dashboard gives you access also to contextualize open interest for every tenor. And by precisely hovering over each tenor, for example, we were looking at the September contract, you can access precisely how many millions of barrels have been sold or bought from Onyx. And this can be done on a breakdown tenor by tenor. Last thing, which I think might be useful to know for our viewers, is that we provide access across multiple products covering crude, oil products, and NGLs market. And lastly, the dataset is accessible throughout outright contracts, spreads, quarters, and calendar years.
And from my side, in my concluding views to share with you, is that Onyx is giving you a mix, a very powerful combination of technical indicators as well as physical and futures indicators of what is happening in the front end, what the swaps are doing today, what is the balance month pricing at, and what is the physical pricing at. And then you can combine all this information with your technical dashboard. And hopefully you're wiser by that.
Finally, as always, please don't forget to smash that like button and hit subscribe. There's a lot more Onyx content available. So please visit our website, our LinkedIn, and our YouTube pages. Thank you very much.